Alrighty, it looks like I'm live. I'm going to spend just a second kind of collecting my thoughts, and then I'll dive right into it. Um, so this is the book Common Stocks as Long-Term Investments by Edgar Lawrence Smith. This is a very interesting and kind of rare book that I've been reading lately. I've been making a video on Picking Growth Stocks by T. Rowe Price Jr., which is kind of it goes really well with this book. It's a really interesting pair of books to have together, and it's unfortunate that neither of them are available for purchase digitally. So that's why I'm doing this whole document camera setup. But I think the books are very interesting. I think the context around them is very interesting as well. And especially for this book, it's jam-packed full of very useful, broad information that could still be helpful for investors today. So I'm going to start by reading Warren Buffett's 2019 shareholder letter, where he mentioned this book. And then I'm going to actually open the book and dive in to some of the interesting details. Let's see. So this is the 2019 shareholder letter from Berkshire Hathaway. It is famous in the world of capitalism for like kind of being, it's almost like I wouldn't call it a cult, but in like Omaha, Nebraska, they certainly have just become kind of the group of people that everybody listens to for direction in terms of trying to figure out where things are going or where things have been, just because they've been in the industry for so long and have been so successful. So these shareholder letters are pretty famous in investing circles, and we're gonna dive into it. So the shareholder letter kind of first starts off with a little bit of flexing. They show the annual percentage change per share in Berkshire Hathaway, their investment company, compared with the S&P 500, which is a broad index of 500 of the most important and productive industrial companies in the United States. And one can assume that the S&P 500, due to its large size and scale, vastly outproduces much of the smaller companies in terms of earnings, in terms of what they actually do. So it is a very good benchmark, and it's a very hard to beat benchmark over a prolonged period of time for that reason. But somehow Berkshire has managed to do the impossible. If we look all the way back to 1965, we can see they have an interesting track record. And when we have it in parentheses here, this means that there was a contraction or a decline by that amount. So people who might like get scared by something like that, a decline of 48.7%, they won't see the continued prolonged upswing. And that's kind of Berkshire's philosophy. This is Buffett's philosophy that he's trying to relay to us, in addition to the philosophy presented in this book, which is basically that the power of retained earnings allows a productive industrial company to reinvest in itself. And you can be part of that process by owning a share in the company by just buying common stock, and that this power of retained earnings is akin to the effect of like compound interest, and that over time it will have like a snowball effect. And that's the main thesis of this book. But for now, we're gonna keep looking at this this flex here from Berkshire Hathaway. And we can see ups and downs in the market, we can see ups and downs in their portfolio. But as a trend, they outperformed the S&P 500, in their history since 1965. Yeah, and then if we go all the way down to the bottom, compounded annual gain, 1965 through 2019. So I think this is like probably the yearly average gain on capital was 20.3% compared with 10% of the S&P 500. But then if we look at that compounding effect and what that actually does over time, the overall gain from 1964 to 2019, when the shareholder letter was released, is 2,744,062%, which is crazy, compared with only about 20,000% of the S&P 500. And this is taking advantage of the snowball effect, where it's like starting at the top of a big hill, and if you just wait over time, you do pretty well. You know, it's there are ups and downs, but you know, outside of anything crazy happening over a long number of years, that compounding effect works in your favor for most people. So that's the flex to start out with, to let you know they're serious. And then it starts. Oop, sorry, I had the wrong pane open. Okay. So you know, all I was saying was, you know, you can see the contraction years are in parentheses. And just over time, that compounding effect greatly influences the total return. So this is just a flex. So two shareholders of Berkshire Hathaway Inc. Berkshire earned $81.4 billion in 2019, according to generally accepted accounting principles, commonly called GAAP. The components of that figure are $24 billion of operating earnings, $3.7 billion of realized capital gains, and a $53.7 billion gain from an increase in the amount of net unrealized capital gains that exists in the stock we hold. Each of those components of earnings is stated on a after-tax basis. That $53.7 billion gain requires comment. It resulted from a new GAAP rule. So this is just him complaining about changes in what generally accepted accounting principles mean. He says he's not happy with it because it doesn't account for their unrealized gains, and that's just what he's trying to tell investors, is to not freak out because of the numbers, because the numbers don't tell the whole picture. But this is what we're really here for. He talks about the power of retained earnings, and this book from Edgar Lawrence Smith that was released in 1924. So he says, let me just make sure my microphone is still working. Okay, so he says, in 1924, Edgar Lawrence Smith, an obscure economist and financial advisor, wrote Common Stocks as Long-Term Investments, a slim book that changed the investment world. Indeed, writing the book changed Smith himself, forcing him to reassess his own investment beliefs. Going in, he planned to argue that stocks would perform better than bonds during inflationary periods, and that bonds would deliver superior returns during deflationary times. That seemed sensible enough, but Smith was in for a shock. Okay. His book began, therefore, with a confession. These studies are the record of a failure, the failure of facts to sustain a preconceived theory. Luckily for investors, that failure led Smith to think more deeply about how stocks should be evaluated. For the crux of Smith's insight, I will quote an early reviewer of his book, none other than John Maynard Keynes. I have kept until last what is perhaps Smith's most important and certainly his most novel point. Well-managed industrial companies do not, as a rule, distribute to the shareholders the whole of their earned profits. In good years, if not in all years, They retain a part of their profits and put it back into the business. Thus, there is an element of compound interest, Keynes italics, operating in favor of a sound industrial investment. Over a period of years, the real value of the property of a sound industrial is increasing at compound interest, quite apart from the dividends paid out to the shareholders. And with that sprinkling of holy water, Keynes is a legendary figure, especially in the philosophies he came up with after the Great Depression. People argue about some of these philosophies, but there is no arguing that Keynes was a incredibly bright individual. So Buffett says, and with that sprinkling of holy water, he's kind of digging at Keynes' legendary status, Smith was no longer obscure. It's difficult to understand why retained earnings were unappreciated by investors before Smith's book was published. After all, it was no secret that mind-boggling wealth had earlier been amassed by such titans as Carnegie, Rockefeller, and Ford, all of whom had retained a huge portion of their business earnings to fund growth and produce ever greater profits. Throughout America, also, there had long been small-time capitalists who became rich following the same playbook. Nevertheless, when business ownership was sliced into small pieces, stocks or common stocks, buyers in the pre-Smith years usually thought of their shares as a short-term gamble on market movements. Even at their best, stocks were considered speculations. Gentlemen preferred bonds. Though investors were slow to wise up, the math of retaining and reinvesting earnings is now well understood. Today, school children learn what Keynes termed novel. Combining savings with compound interest works wonders. All right, make sure my microphone's still working. At Berkshire, Charlie and I have long focused on using retained earnings advantageously. Sometimes this job has been easy, at other times more than difficult, particularly when we began working with huge and ever-growing sums of money. In our deployment of the funds that we retain, we first seek to invest in the many and diverse businesses we already own. During the past decade, Berkshire's depreciation charges have aggregated $65 billion, whereas the company's internal investments in property, plant, and equipment have totaled $121 billion. Reinvestment in productive operational assets will forever remain our top priority. In addition, we constantly seek to buy new businesses that meet three criteria. First, they must earn good returns on the net tangible capital required in their operation. Second, they must be run by able and honest managers. Finally, they must be available at a sensible price. When we spot such businesses, our preference would be to buy 100% of them, but the opportunities to make major acquisitions possessing our required attributes are rare. Far more often, a fickle stock market serves up opportunities for us to buy large but non-controlling positions in publicly traded companies that meet our standards. Whichever way we go, controlled companies or only a major stake by way of the stock market, Berkshire's financial results from the commitment will, in large part, be determined by the future earnings of the businesses we have purchased. Nonetheless, there is between the two investment approaches a hugely important accounting difference essential for you to understand. And so he just goes more into complaining about GAAP accounting principles, which is kind of not what we're here for today. We're here for examining this concept of retained earnings and this book by Edgar Lawrence Smith. So that's what we're going to do now. Interestingly enough, I think like Yahoo Finance is a big tracker of Buffett and like just about everything he says and does ever. So they actually, I think, own the rights to this book now. And this was a reprinted edition. It was like $10. I don't know how they like reprinted it. If they found like the original plates or whatever for printing it. But it is, it is an interesting book, and it's a rare book, and it's pretty much impossible to find digitally. So basically, as Buffett said, Edgar Lawrence Smith was coming into this analysis thinking that during a deflationary period, bonds would be a safer and more sensible investment than common stock, because of the monetary factors working in its favor. But so he went into this study, attempting to prove that. But very interestingly, and this is something that scientists will encounter every so often, he actually had a enormous failure and was completely unable to prove that at any time period that he examined. And so what that told him was there was something going on that made common stock equities fundamentally different than bonds, and that's what he examines in this book. So he says these studies are the record of a failure. The failure of facts is to sustain a previously conceived theory. This preconceived theory might be stated as follows. While a diversity of common stocks has, without doubt, proved a more profitable investment than high-grade bonds in the period from 1897 to 1923, during which dollars were depreciating, yet with the upturn of the dollar, bonds may be relied on to show better results than common stocks, as they did in the period from the close of the Civil War to 1896, during which the dollar was constantly increasing in purchasing power. Based upon a general understanding of the results which logically follow changes in the purchasing power of the dollar, such a theory should have been demonstrable, and the tests of the comparative investment value of bonds and common stocks covering the period from 1866 to the end of the century, which are outlined in the following pages, were undertaken in its support. But they failed because, quite unexpectedly, they demonstrated that the premise upon which the preconceived theory rested, namely, that high-grade bonds had proved to be a better investments during the period of appreciating dollars, could not be clearly sustained by any evidence available. The preconceived theory was, therefore, abandoned. So he's saying that he looked through a lot of history, which is part of why I like this book so much. It examines a lot of history, and I think things are always constantly changing, especially with technology nowadays. But it's hard to argue against history and data, and that's what Edgar Lawrence Smith does in spades in this book. And so he says he tried to prove that during deflation, bonds would be a better investment and safer or whatever, for like a long-term investment. But he was basically said that he proved the opposite. The facts assembled, however, seemed worthy of further investigation. If they would not prove what we had hoped them to prove, it seemed desirable to turn them loose and follow them to wherever end they might lead. Fortunately, they seem to have led to the isolation of certain characteristics inherent in a diversification of representative common stocks, which may be of value to those investors who have given small heed to the long-term investment attributes of this class of security, and to others who, while drawn to the common stocks, have felt that their leaning in that direction should be repressed as lacking in conservatism. So this is a fancy, very academic 1920s way of saying that, before this book, even with like a diversified basket of common stock shares in a business, people at the time thought that as very, very speculative and not a appropriate vehicle for like retirement planning, investing, even over a long period of time. But what he's saying here is that there are certain characteristics inherent in a diversification of representative common stocks. So what does that mean? That means that if you own shares in a business, so you own a part of a business, and you own a diverse share or a diverse basket of shares in a bunch of different businesses that are representative of the current economy, are long-term investment attributes of this class of security which are favorable. And that's all he's saying. Bonds as a class have certain recognized attributes. A diversification of common stocks has its own attributes, which differ from those of bonds. Each class of investment has its useful purpose and its proper place in any investment plan. A clearer understanding of their differing attributes may help to determine the relative proportion of each of these two classes of securities, which will best serve the investment requirements and purpose of each investor. And it's 1924 in New York, Edgar Lawrence Smith. And so he thanks a lot of the library people who helped him out. And then we just see this foreword again by Warren Buffett. This is out of his 2019 shareholder letter. I'm going to look at the table of contents real quick and just talk about some of the different chapters and what I took away from them. So we start off with a very interesting, and this is kind of relevant today, looking at bonds and the dollar during both periods of inflation and deflation, like over a long historical period. Comparing stocks and bonds over the roaring 20s, up to the craziness. Comparison between stocks and bonds. This part I think is very useful today because it gives a long history over a period of like post-war. It's interesting. So this chapter goes very much into the favorable attributes of common stock, and then more consideration of financial conditions, railroad stocks. So this is where he starts diving into the diversifying into a basket of equity. And then, okay, so this is his core idea here in chapter 9. And in chapter 10, he does a whole bunch of examples where he shows, even, in that boom period, if you purchased at, the exact peaks, you purchased at the exact wrong time and were just incredibly unlucky, and you just held for a long, long period, that it was more likely than not going to work out in your favor, even if you did everything wrong. This is not investment advice. This certainly has its historical context over the period that he examined from 1837 to 1923, namely that during that period, industrialization was increasing at leaps and bounds. It was a compounding effect of the economy of the United States. You think about how people lived in 1837 compared to 1923. This is closer to us, like in magnitudes in the 20s. Like they had refrigeration, television, radio, cars, trains, and by that time, that's when, you could consider that the basic properties of industrialization had matured. So it's vastly different from here, and that's why this exists. And that's kind of what T. Rowe Price dives more into in his book. Is, he wrote in 1939, just a couple of years before World War II, and he argued that America had kind of reached a very high peak of industrialization in 1929, and that the returns were predicated on different conditions than they might have been over the past century. So yeah, he goes over the time hazard, generalities, fluctuation in bond values. So he gives a very interesting account of saying, if you buy a fixed dollar investment like a bond, you're buying somebody's debt. It has a set and known rate of return. But if you want good yield, you have to buy corporate bonds. And if you were going to buy, the debt from a company, that's risky. The company could default. Any number of things could happen to the company. technically, if a company goes bankrupt, the bondholders are paid before the shareholders. But he basically says the only way that you can know a bond is safe is if the company backing the bond has good prospects and will, safely earn a profit over time. And so his argument is, if that's the case for any bond that you're looking at, why on earth would you buy a bond instead of just buying a share in the company? Because the share in the company has the possibility of reinvesting in its productive potential. He was saying at the time, like, as cars and roads were being built out in the United States, like at a dizzying scale, and just all these different things were happening, up to the 20s. He was saying if you buy a bond, you're buying a set amount of debt and it's at a fixed rate. If you buy into shares of productive industries, you're investing in the compounding and growing production and kind of like everyday consumer needs that are constantly growing. You think about like in 1866, you didn't have to go out and buy a television, a radio, a car, a refrigerator, all that to function in society. By the 20s, that's vastly different. And he says if you buy bonds, you're just buying debt and it's at a fixed rate. But if you buy common stock during this period, it moves just as rapidly as the society moves, and its returns reflect that. He gives a lot of data to prove a lot of this stuff, and then he proposes kind of the concept of mutual funds, which you've probably heard of nowadays. People still consider it a good idea to invest in a mutual fund with a low expense ratio, and he goes over a proposed type of fund based on these principles, which after this book was released in 1924 became wildly popular. So again, I like this book. It goes over a long period of history. This is a really neat chart on one of the pages showing a 2.5% compounding rate, and how that correlates, that follows with the compounding property of a composite of common stock from 1837 to 1923. So it's crazy how much this follows that 2.5% trend line. I think he shows somewhere else that that's roughly also the rate of growth in the population, which is super interesting from a mathematical perspective. I want to see if I can find that chart as well. This is an interesting tidbit I want to read through quickly. So he talks a lot about the risks of a fixed dollar and investment in a world of a depreciating currency. And so he says, what the final outcome will be in Weimar Germany cannot be foreseen, but we do know that the demoralization of currency values has completely wiped out the creditor class. So people who loan out money and expect to retain, get a certain percentage of increase in that money as the loan is paid back. The holders of bonds who depended entirely or in large part upon the interest they received became paupers, and the industrial leaders who, through the ownership of large blocks of common stock which control the processes of industry, and who were shrewd enough to use the depreciating mark as a method of increasing their common stock control, are today the most powerful men in Germany. So this is pre-World War II. This is like Weimar times. What the future holds for them at the hands of political powers outside of Germany cannot be foreseen, but to date, they have prospered inordinately. Our own currency has depreciated very greatly in the last 20 years, and our own holders of common stocks have profited in proportion, at the expense of our investors in bonds. We cannot foretell whether the dollar will appreciate rapidly during the next 20 years, as it did in the period from 1866 to 1885, but our enormous gold reserves of today, as opposed to our inadequate gold reserves of 1866, may lead us to question whether such a rapid appreciation is likely to occur. So, chapter 13 talks a lot about the fluctuation in the value of bonds. This is where he dives into, this concept of really looking critically at what bonds represent. You're buying somebody's debt. Um, the yield on that debt can be vastly differing depending on how risky that company is, viewed. He's of the opinion that if you're going to be buying debt that's characteristically safer, well, not characteristically safer actually, but it's characteristically different than owning common stock. And it still has risks, and that's what he says, is it still has risks. He doesn't believe that it's worth it, in terms of the limited reward and the comparable risk. So I'm kind of glossing over. There are lots of pretty charts and nice, concise, very informative data in this book. I'm kind of skipping around. I really want to see that chart that showed the growth in equities, um, reinvestment being pretty much proportional to population. Like they were almost neck and neck. And I think mathematically that's a very interesting um, set of data that economic growth trends exactly with population growth. So this chapter, I think this is chapter. Well, it's page like 71, anyways. He does a bunch of different case studies, again, looking at if he bought at the exact worst time, but bought broadly on a very dumb selection criteria, which was just the volume of shares traded and what would happen over, like, say, a 10 or 15-year period. For him, at that time, the results were favorable. And that provided a good proof of his thesis and a proof of the argument that a broad share of common stock has favorable attributes. So I think some really important context for this book is it was released during the later stages of an industrial boom, and it was released before the Great Depression. So I think those are two very important points of context. But again, this is after a whole bunch of proof and stuff like that. He mentions the 2.5% that we saw in the previous chart. I was unable to find the text. I think it was like some auxiliary text where he talked about population growth and how that mirrored almost exactly the value growth. But this kind of paragraph sums up a lot of the ideas. He says the law of increasing stock values and income return. Notice he says law. He believes it's a law, not a guesstimate or qualitative, like, of observation. He believes this is akin to like a law of physics. Over a period of years, the principle of a well-diversified holding of the common stocks of representative corporations in essential industries tends to increase in accordance with the operation of compound interest, chart number 6, which we just saw previously. Such stock holdings may be relied upon over a term of years to pay an average income return on such increasing values of something more than the average current rate on commercial paper. So yeah, that's all that I was able to glean from this book. I think this book is really interesting, and I think a lot of people should read it today, just given the breadth and the diversity of the history it covers. This book was written in 1924, but it has, almost a century and a half of economic history in it. And the conditions over that time varied wildly from peacetime, wartime, inflation, deflation. There's a lot of useful things to take out of this book. It's unclear where we are currently, but I think anybody could read this book and glean some interesting and useful insights. I mean, you look at how many, when I was reading it, little sticky notes I made. There are a lot of little very interesting nuggets of economics in here. And I think outside of kind of what Buffett was talking about with this book, I think just the history presented in this book is interesting enough to warrant an observation if you're interested in that kind of thing. And something that I'm really sad about actually is that this book and like this collection of journal articles, are rare. They're very rare. And they're not easily accessible information unless you were to buy the two books. The books are cheap, thankfully. They're not like some of these crazy expensive books. But it's interesting. Coming up shortly on my docket, a book that I really want to read is The Intelligent Investor by Benjamin Graham. I've kind of been mentally preparing myself for actually diving into it because it is a big book. But that's kind of next on my docket, just for understanding these kind of things. And I hope you found this quick recap highlights video interesting. And again, for this book, reading it almost 100 years after it was written, it is crazy how relevant and how insightful and lucid a lot of the thoughts are in here. Like, it is very interesting. This author, Edgar Lawrence Smith, is incredibly bright and is incredibly gifted with the use of language, even for it being old timely. So yeah, I hope that's interesting. I hope that's helpful. See you next time. I will be reading probably chapter 5 in this book. So take care.